Good evening, Fly Girl. How are you? Welcome back. Jose Khadi, Brett. Good evening, folks. Good evening, and welcome to Thursday Night TikTok Live. TC, how's it? Good evening. It is Thursday night, and as per usual, it is Q&A night. So let's rip. Send me your questions. Let's see if I can answer them. And let's see where we go from here. And while the people are coming in, and I'm saying hi to a few of you, maybe we should touch on something while we are at it. So this year, we're sitting with a situation that there's now a war that has broken out between United States, Israel, and Iran. And everybody is worried, well, what's this going to do to my investments? And quite frankly, we've already seen that on Monday, markets opened down. They went down because fear always creates markets to dip down. And today is Thursday, and we're already seeing an uptick or uptick in some of these markets that went down. So my personal opinion is I don't think too much is going to happen. I don't think this war is going to have too much of an effect. I think 2-3 weeks down the line, we're going to be sitting here and having a discussion as if there's been absolutely no war. And this is similar to the same trend that we saw when Russia and Ukraine started off in their war. So I've already had people saying, oh, my investment has dipped, it's down 10% or 5%, whatever the case might be. Must I withdraw? Must I take my money and put it into something safer in the bank, whatever? Now is exactly not the time to withdraw funds. So if you have an investment, please don't go and draw it because of what's happening worldwide, especially if it's invested with a good company, good portfolio managers. Just ride it out. Don't get too panicked. And the only time that you're going to have a problem now is if you at a point where you do not have a choice, you have to withdraw the money, then you're going to take a bit of punishment. But I think for most people, we can all wait or hang on there for a month or 3, 6 if necessary, for any portfolio or market to recover if need be. So yeah, that was just a little something to start us off with and have a quick chat about. I see we have our first question for the evening, and the question comes from Busi Belakazi. I hope I pronounced that correctly, Busi. Allan Gray tax-free balance fund is safe to invest in? Well, we'll see. Excuse me. It's safe in the sense that it's a balance fund, okay? So it's a medium risk fund. It's not a high risk fund. So basically on medium risk funds such as these balance funds, the portfolio manager has the authority to go and put more shares in or take more shares out of the investment, which means a balance fund normally and typically has about 65 to 75% of the total investment value invested in shares, okay? But that portfolio manager has the discretion to, when they see that the markets are taking a downward turn like it is now, to say, listen, we want to sell off more shares, have less shares, and have more money in cash or bonds or properties. And so, especially on somebody like Allan Gray, good portfolio managers, if they move the money now, it's too late. Basically, that falls in with what I was just talking about, the war. If you want to move it now, it's too late. You just hang in there until everything recovers. But if it's a good portfolio manager and they kind of foresee that there was this possibility of war and that war is going to happen, and they said, listen here, let's sell off, they would have started selling off 2-3 months ago and made sure that they got the balance right, in that there would be less shares and more cash and property, etc. Having said that, I don't think too many of the companies that's got balance funds has gone that route, because I don't think anybody expects at this stage that this war is going to be a major thing. It's a blip on the radar of stock exchanges. So the Allan Gray Balance Fund is a good fund. It's a medium risk fund. Yes, it can go up, it can go down. And it's not safe in the sense that it's like a bank account where your balance will remain as is plus interest. It's also not safe in the sense that it's a guaranteed fund where if you put it in, you know that you're going to get X amount back at the end of the day. It's safe in the sense that it's well diversified, and that if you leave your money there, and you leave it there for an extended period of time, it's safe to say that you will get a positive and a good positive return. Over the short term, it's going to go up and down. It is, after all, still a fund that's invested in shares, and therefore it is still a fund that will go up and down following the market and depending on how well it is managed by the portfolio manager. So Busi, I hope I've answered your question. What I can tell you is if you are in a tax-free investment and you're going to stick in there, especially if it's something like a balanced fund, as long as you're going to be in there for a while, 3 years, 5 years or longer, don't worry about it. It's a good fund. Okay, it's a good fund. Keep it there. Somebody must tell Angry that I always tell people that they have good funds because they have to start paying me money for doing this, I'm sure. Oh, no, Busi, you say you were worried about the growth and thought it was too aggressive because of planning to put 46 now. No, go for it, Busi, absolutely, go for it. And Busi, like I say, especially if your intention is to stick around in the tax-free investment for a long period of time, very, very nice fund. Don't worry about it. It's a good fund. Let's see who's next. Ding, 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 ding. Jameson Crossfield. Good evening, Jameson Crossfield. I don't think I have seen you from before on one of my TikTok lives, so welcome, sir. Your question is, if I resign at GEPF, work for 20 years, I'm around 1.3 million now, how much can I be taxed in that regard? Oh man, why do you want to do that, my good man? You mean that you want to resign and you want to withdraw the funds. That's what you mean, eh? Okay, so let's have a quick look here. Withdrawal tax table says that if you've got 1.3 million rand, and let me just do this calculation for you quickly. Oh, wrong calculator, my apologies. Ding, ding, ding. If I can just get my fingers to work. Okay, so let's say you've got 1.3 million in your GEPF pension fund and you want to withdraw it, then it means that you are going to pay times 36% equals plus 223740. It means that you're going to pay 299,700 rand in taxes, which means you are going to walk away with basically R1 million. So, my good friend, Mr. Jameson Crossfield, if you want to resign from the GEPF, please, whatever you do, try not to withdraw the funds. If you've got a wonderful new job you're going to, if you're going to a different country, whatever the case might be, try and protect your capital by moving it to a preservation fund. It will be moved over tax-free, so the full 1.3 million will move over, and it will keep on growing in a preservation fund until you get to retirement, and that will then give you the opportunity at retirement to draw a large sum of this money tax-free, and then start taking an income, and depending on how much capital is in income, you're going to pay substantially less tax than what you're paying now, or maybe even no tax. Now that is a much better situation than paying 300,000 rand of your 1.3 million in tax, because it means that you're paying almost 30% of the capital that you have in tax. And trust me, if you've worked for this for 20 years and you withdraw it now, you will never make it back up. You won't catch it up, I'm promising you. You might save up 1.3 million rand again going forward, but your 1.3 million rand that you're drawing would have been 2.3, 2.5, 4.5 million rand in the future, and that's the money you won't make up. So you will be in a much worse position when you eventually get to the point one day that you actually want to retire or semi-retire or just have more time to do the things that you want to do. So Jameson, there is, you know what the tax implication is. Please, whatever you do, before you withdraw, go and think long and hard. speak to other people, get more planning then done. Just be careful, okay? Lionel Bruver, good evening. What's this? Offshore wind turbines at work. Well, interesting names that I always find it interesting to read everybody's names. Like Fish has joined us tonight. And Yamamatu has joined us tonight. And Jason, good evening, folks. Welcome to all of you. Busi says, so much tax. Yes, Busi, that is so much tax that the man will pay if he decides to withdraw. Okay, next up is GK. With current situation in the world, is it a good time to invest now or wait as a crash is predicted? GK, you won't believe it, but I opened tonight's discussion with regards to what's happening in the world. And trust me, there is no better time to invest than exactly now. Because some of the markets have shown a bit of a downturn on Monday, but they are starting to recover already. But if you look at global equity funds, for example, global equity funds has taken a bit of a downturn, and it's not because the share prices has necessarily gone down. It's because of our rand that is suddenly so strong against the dollar, which is actually the dollar that is weakened. So a rand trading at 16 rand 50 to the dollar at the moment is not really a true reflection. At the end of the day, our rand should be closer to about 20 rand to the dollar. So if you invest, especially in things like global funds at the moment, whatever you buy at 16 rand, call it 16 rand 15 to the dollar. And then once the dollar starts strengthening again against the rand, and it gets to 20 rand to the dollar, you've already made basically 20%, because that's the difference from 16 rand 50 to 20 rand. You've made 20% growth on your investment just on the rand dollar exchange rate. Then we haven't even spoken about what the share price has done. Okay, share prices that are currently taking a bit of a hammering. Once all of this is over and done with, then they will recover again. So no, it's always a good time to invest. That is my honest opinion. It's always a good time to invest. The secret in investing is never about the timing. Oh, must I invest now because of a crash? No, I'd rather wait until the crash is over. The secret is in how long you can leave that investment. The one thing that you will see now is, let's say that markets take a dip by 10 or 15%, even 20%, okay. People are going to start getting scared and they just want to get out of their investments because I'm losing money. Instead of just holding on to that money and holding on to that investment, because it will recover and they will get back their 20% and it will grow more. People that want to time the market now is going to sit and they're going to say, okay, market's down 10%, 15%, 20%. Okay, I'm just going to wait a bit longer to see where's the lowest I can hit it. And then it goes from 20 to 15 and they go, okay, but it's most probably going to drop again tomorrow. And then it goes from 15 to 10, okay, maybe tomorrow. And by the time it's only down 5% from 20%, then people want to invest. Then it's too late. You've missed the growth. You've missed it completely. Oh, I wonder what's going on here. I don't understand this. But anyway, so the bottom line is, do not try and time the market. And now is a very good time to actually invest. So GK, it's maybe a bit of a long answer that I've given you, but I hope it makes sense. Jameson, it's a pleasure, so absolutely. Dennis says, hi Corey, can I pay an annual amount from RA, and what would the amount be that is tax-free annually? Okay, so Dennis, remember that when you invest into a retirement annuity, whatever you put in is not tax-free. What you put in has a tax rebate. So this is the wonderful thing about a retirement annuity. Yes, you can put in an annual amount, and that annual amount, if you're not going to do monthly premiums, or even if you're going to do monthly premiums, legislation says you can invest as much as 27.5% and now 450,000 Rand per year. So you can do 27.5% of your gross income as a contribution, and if your 27.5% is more than 450,000 Rand, If your 27.5% is more than 450,000 Rand, you limit it to that 450,000 Rand. Now, if you invest that amount of money, okay, so it doesn't matter how much that amount of money is, whatever you invest, the personal tax rate that you have, that's what you get back. So let's say that you invested 100,000 Rand on your retirement annuity and your tax rate is 36%. It means that at the end of the year, when you do your tax return, SARS says to you, you've given 100,000 Rand to a retirement annuity, we're giving you 36,000 Rand back for being such a good person and for making your own provision for retirement. But that's not all. That 100,000 Rand grows, and all the growth that is earned on that investment is tax-free as well. So just like a tax-free investment, just like a tax-free plan, all the growth on your retirement annuity is also tax-free. And so there you go. So then as your annual amount for your RA that you're going to contribute is going to depend on what your personal gross annual income is. And then, like I say, limit it to 450,000. If your contribution that you can make, your 27.5% is 500,000, for example, you can still invest the full 500,000 into your retirement annuity. All that's going to happen now is that you will only get the tax deductibility on 450,000, and the 50,000 that's extra will roll over to next year, and you can get the tax deductibility then. If you can never make use of it because you fill up your maximum every year, then at retirement, instead of getting 550,000 tax-free, you can now get 600,000 tax-free. So you never lose out on the benefit. And that's the important thing. You never lose out on the tax rebate benefit. And that's one of the things that makes retirement annuity so absolutely fantastic. Razak, does the tax-free investment amount of 500,000 includes the dividend? No, Razak. The tax-free investments that has now been increased to 46,000 Rand per year that you can contribute, it just says that you cannot contribute more than 500,000 Rand over your lifetime. And does not include the dividends, does not include the growth, does not include the interest. So it's 100% 500,000 out of your own pocket that you can invest, and all the growth on top of that is tax-free, and the growth on top of the growth is tax-free. So it is just better and better and better. And that's why tax-free investments are a great investment if you're going to do it for a long period of time. Great for planning, great for education, great for retirement, great for so many things. Only time a tax-free investment is not good is when people invest and withdraw every year or second year, which seems to happen a lot. People don't grasp that they're only shooting themselves in the foot by doing that. Non-Klaus, Razak, yeah, that's it that you put in there. We just discussed that for you, sir. Let's see who's next. Flip Flops has joined. Good evening, Flip Flops. And Bester and Brian Rambele. Lizzie says, why is that funds are closed for investment, like when you do an ad hoc you can't allocate? Lizzie, there can be a number of reasons for that. It could be that the investment is not offered by the company anymore. Very often it happens that investments is run their course. There's a better investment with better fees, better portfolios, better structure, and then that investment stops and they don't offer it anymore. Portfolios, some portfolios just have run their course and they don't do as well as they've done, or they become too big, and therefore the portfolio manager can't manage it as well because of the rules that is attached to it. Because remember, portfolios, unit trust, whenever a company registers a portfolio unit trust with the FSCA and what's the other ones? I can't remember the other body. They say we will manage this fund in the following way. We will have X amount in equities, we will have X amount of cash, we won't have more than this, less than that. When we start selling off, especially if we've got a big holding, we won't sell everything at once, we will sell 5% a day or something like that. So sometimes these portfolios just run their course, they're not as effective as they used to be, and then the company decides to close it down in favor of something that is better. So if you cannot invest funds in a certain investment or certain portfolio, the financial advisor that you deal with should be able to tell you what is in that fund or in that portfolio or in that investment place, and you're most probably going to find that it will be a better product than the last product. Okay, so don't worry too much if you can't add ad hoc. As a matter of fact, it gives you the ideal opportunity then to go and move your funds and your investment from that old investment that's not working so well anymore. Tip says, what about investing in Russian oil companies? Tips, I don't know. It's like asking me, would it be better to invest in Russian vodka? I don't know. I don't deal in specific shares or specific commodities or anything like that. I deal in investment portfolios where I find a portfolio with a risk profile that's in line with what the client needs. I give the client that, and the portfolio manager that's standing behind me, he's the one that manages it. So the portfolio manager or the economist, those are the people we have to ask, what do you think about investing in Russian oil? I suppose if you've got enough money to have a good diversified portfolio, hey, then why not? But just out of the first like this, I've got absolutely no idea. I'm not even going to try and venture an answer on that one. Let's see. The girls love Aisha. Good evening, the girls love Aisha. Steph, Money, Acumen. Yeah, such interesting names. King Priest. Tubbs. Bianca Kutsia. Let's see who else. GK, you back on yours. GK, let's go for you, my mate. Okay, on endowment, which is 5-year term, can you increase 20% additional contribution yearly without penalties? Yes, GK, you can. But 20% is the limit, okay? So on endowments, if you invest in an endowment, and let's say you've invested 100,000 Rand in total for the year, next year you can invest 120,000 Rand, and then it remains on 5-year. But if you invest 121,000 next year, you break the 20% rule, as they call it, and then they say, okay, your 5-year term is now extended to the 6-year. You must wait another 5 years now before it becomes open-ended. That's all that happens. Just means that your endowment term increases by 1 year. If you do it in year 3, okay, then it's another 5 years from there. So a 5-year becomes an 8-year. The endowment term just increases to the point at which your investment becomes completely liquid. That's all that happens. In the interim, nothing changes. Yes, if you want to make a withdrawal, or if you make a disinvestment or interest-free loan, as they call it, you will be impacted when you do something like that. But the 5-year term on an investment is just to ensure that after 5 years, all your funds are absolutely after tax money. All the growth you get keeps on being after tax growth. And after 5 years, your funds become completely liquid like it is in the bank, and you can withdraw as you please, when you please. That's the beauty of an endowment. Okay. Miss M has joined us. Good evening, my Gigi. Nice to see you again. Interesting how many people has joined us tonight. Let's see who else is there. Bob Bakuna, good evening. Eugene Matapo, Lana joined us, Dunkel joined us, John Dre van Dijk, good evening John Dre. I wonder if this is the John Dre I see in gym every day. Well, lots of people joining us, not lots of people are asking any more questions, so maybe I'm going to have an early night. Antoinette Crick and Anastasia and Miss T. Yeah. Triple V has joined us. Docatella has joined us. What's this thing? Encourage your viewers to send gifts and thank them for their support. Okay. My followers and my viewers, thank you very much for watching my TikTok live. I don't know how and what this gifting is. I've seen it so many times, but I have absolutely no idea. Any case, any more comments, folks? Any more questions? I actually thought there's going to be a lot more. There we go. Q Lupila Clifford says, good evening. Whoa, shucks. maybe it's time to plug in this little boy here, otherwise we're going to run out of power. Completely forgot about that part of the exercise. Just a second, let me just get this thing. There we go. Back in action. Okay. Can I only open a one tax-free savings account? Kilopele, you can open as many tax-free investments or tax-free accounts as you want. Okay. There's absolutely no limitation according to law as to how many of these tax-free investments you can have. But, and this is the but, as of the beginning of this week, you cannot invest more than 46,000 Rand per year in your tax-free investments. So if you've got 10 different tax-free investments, it means you can only put a maximum of 4,600 in each of them to make up your 46,000 Rand. Now, to do that is not very sensible, because quite honestly, you then just over diversifying. That's number one. Number two, which is more important, is to keep track of which investment has how much in it, and to make sure that you do not go past the 46,000 Rand limit. That is going to become the problem. And trust me, SARS will know. You might battle to keep track of it. Trust me, you might be. But SARS, they've got the systems, mate. They've got the systems. Every one of the companies that you have this tax-free investment with sends to SARS a tax certificate at the end of the year, in which they tell SARS, this man has contributed 5,000 with us, 10,000 with us, 15,000 with us. Now, if you didn't keep track of it and you've invested more than 46,000, then you've got a problem, because now you're being taxed at 41% for every Rand that's more than 46,000. So my honest opinion is, it is not worth it having more than one tax-free investment per person. If you have a wife and you've got children, well, then go and open a tax-free investment for you, open one for your wife, open one for your son, open one for your daughter, and in that way open one tax-free investment for every family member if you want to do that. But in your personal capacity, preferably have just one tax-free investment. Make sure it's a good one. That's as easy as that. But don't go and open more than one. Honest opinion, you're going to shoot yourself in the foot, and I don't think you're going to get the growth that you should be getting if you've got just one investment. Because normally what people then do is, if they've got more than one investment, they tend to say, okay, this is a very conservative investment, so I'm going to take very little risk on this one. This one I'm going to take a lot of risk. This one I'm going to have a medium bit of risk, a bit of risk, and no risk. And then at the end of the day, they end up with a medium risk portfolio if they put everything together in any case. And they did not achieve their goal, which might have been, listen, yeah, I want to be in a very aggressive portfolio. So for that reason, I think that sometimes we try to be too smart in diversification. We over diversify, and then we diversify ourselves out of growth. Now, I'm the first person that will tell people that they have to have a diversified portfolio. But if you over diversify, it's also not good. Because once again, if you are an aggressive investor and you over diversify, you end up being a low or medium risk investor, and you do not achieve the growth rates that you want because you're not in the right portfolio, risk portfolio. So yeah, it's all these lovely little things that makes my life interesting and keeps me very entertained when I speak to clients and when I have to advise them. Eunice Juju5 says, good evening to you. Floyd Sullivan says, hi, if you have a pension fund, does the 27.5% for RS still apply, or will it be less? Floyd, so it will be less, because what legislation says is you can contribute and deduct for tax purposes, rebate on your pension fund contributions, up to 27.5% of gross income, and that's made up of all contributions to all pension fund products. So if you have, because some companies actually have a provident and a pension fund, and the people that work there belong to both. So if your company has got a pension fund, a provident fund, and you've got a retirement annuity, the total that you contribute towards these three products must be 27.5% to get the maximum tax deductibility. So if you work at a company where the total contributions is 15% and you do 5% to the provident fund, 10% to the pension fund, you're left with 12.5%, sorry, that you can do in your personal retirement annuity. Do not get 27.5% per product. Okay, Floyd, so I hope that answers it for you. It's an overall over all pension products. Okay. Let's see who's next. Good evening, Mr. Mark Hoffman. How are you doing, sir? The limits is for all retirement funds, so includes pension and provident fund. There we go. Henk Adrianse. Henk Adrianse says, hi, do I have to take my lump sum when going on pension, or can I just move it to avoid paying tax? Hendrik Adrianse, sir, you do not have to take your lump sum when you go into retirement. Now remember that you can take up to a maximum of 1/3. I would not advise you not to take it. I would advise you to definitely take it. Maybe not everything, but a good chunk of it. For example, if you are going to get 1 million rand as your 1/3, okay, so let's assume your pension fund is 3 million, therefore you're going to get 1/3. If you take 1/3, the first 550,000 is tax free. The second 220,000 is taxed at 18%. The next 230,000 is taxed at 27%. So if you were on a 30% tax rate, personal tax bracket of 30%, taking 1 million rand, you're still paying less tax than what you would have paid in your personal capacity. If you go and do that little calculation that I've just explained to you, and you do the sums, you find out that you pay like 19% tax overall on that lump sum, or even less. So I will definitely take a lump sum, if not the whole lump sum, then a big portion of the lump sum, and I will then use that lump sum to go and do different investments which can give me better products, which gives me better tax structures. Okay, and then I would use my 2/3 to buy myself an income with, and because I'm taking a smaller portion, not the full pension fund, but only 2/3 of it to go and buy myself a pension, I get a smaller pension, which means in retirement I'm paying a smaller tax. Okay, and that 1/3 I then use to buy different income products, which is basically tax free, to add on to that 2/3. So now I'm getting from my 2/3 an income amount that is taxed at, let's say, 26%, 26% instead of 36%, and on the 1/3 portion I get an income which is basically tax free, so I still get the same amount of income from my 2/3 and 1/3 that I would have gotten if I left everything together in my pension fund and bought an income with everything. I still get the same income, but I'm paying less tax now because of how I structured my 1/3, 2/3 exercise. So Henk Adrianse, sir, I would not advise you to move that money somewhere else to avoid paying tax, because you won't avoid paying tax. You will actually incur for yourself a bigger tax situation, or a bigger tax problem, I could call it. Okay, Doe says, can I move my tax free to another company? Yes, Doe, you can indeed. When you move it from one company to another, there's basically a certificate that gets issued. Oh, sorry, what the heck? Reismure. Ons het reismure in die huis. It has rained a bit. Okay, so when you move your tax-free investment from one company to another company, a certificate is issued by the receiving company to say we have taken these funds and it's a tax-free investment. They send that certificate to the company from which the money comes, and that company has an obligation then to take that funds and to the certificate and send it on to SARS. If this process is followed properly, then SARS knows, sorry folks, but this is irritating. If this process is followed properly, then SARS knows that the money has come from one tax-free investment to another tax-free investment and everything is cool. If the process is not followed properly, then SARS does not know about this. And then what they end up doing at the end of the year, they see the money as not being transferred, but as an additional tax-free investment. And you could end up having a tax problem because SARS now sees it as too much money being invested in 1 year. So though, just make sure that your financial advisor that you deal with understands this exercise, and when they do it, that they do it in the right way, and then you shop. Okay. Khomotso Mokone, good evening. When it comes to shares investing, which app broker is reliable and authentic? So I do not do share investing, okay. I've got a stockbroker that can do share investing, but we only invest clients' money there who's got 2 million or 5 million. 2 million if you want to invest internationally, 5 million if it is going to be local and international. So you have to have a substantial amount of money. Then any other share buying and selling that you want to do, there is a lot of bank apps and everything. I don't know which is the best. I prefer to make use of EQT, which is part of the Old Mutual offering in terms of investments, and that's where I would go. I know a lot of people always ask a lot of questions about Easy Equity. I can only assume that they are good because a lot of people are making use of them, but I've never really checked them out. I don't know how good or how bad they are, so I can't really speak for them. But yeah, I make use of EQT from Old Mutual, and it's because I can plug it into the other portfolios or the other investments I do for clients. Raps 20202, good evening. He says, hi Corey, hi Raps, how's it? User Ram says, what ETAs would you say one should invest in for long term? Lazy investor to leave and grow for 20 years. My good sir, I do not really make use of ETAs. Personally, it's very seldom that I pick an ETA. I've got some funds that I really like and that I think is good. If it comes to ETAs, and once again, investors with big amounts of money, my stockbroker stroke portfolio manager, he will take care of that. At the end of the day, I think the ETAs you're talking about is ETFs. But at the end of the day, there is a lot of those ETFs that are pretty good. So I'm not going to shoot it down. I just don't like the ETFs that much. I'm personally somebody that likes more actively managed fund. Okay, that is what I like. And the actively managed funds that I support gives good returns. The one ETF that everybody always talks about is the S&P 500, Satrix S&P 500, which is a very good ETF as long as the client understands the risk that's associated with it. So I cannot give you a straight answer in terms of which ETF, because you must also remember that ETFs are similar to normal portfolios in unit trust. Every ETF falls into a certain risk category. You start on this side of the scale with guarantees or very close to guarantees, low risk, and this side of the scale with very high risk, and everything in between. And you as the investor, I can't tell you, listen here, go and do ETF triple X10. And it's a very aggressive ETF for argument's sake, but you are actually somebody that doesn't like to be aggressive with your investments. You want to be more conservative, and you should have been in triple A10, if you understand what I'm saying. So cannot tell anybody based on a question like that which is the best. The only way to do that is, once again, to have a personal discussion, understand your needs better, and once I understand that, then I can maybe say to you, okay, go with company A and product A, or company B and product B. Okay. Rob says, which one offers better return, a tax and tax efficient between bank fixed deposits and endowment policy? Oh my good man, Robs, there is not even a question. The bank fixed deposit will never beat the endowment. Never, ever, ever. The endowment is always better from a tax efficiency point of view than the bank fixed deposit. The only time that the bank fixed deposit will be better is if the tax implication is not a problem for the investor, okay? And if the investor is very conservative and doesn't want to take risk. And those 2 points normally only works for people that's got small amounts. 300, 400, 500, 600,000 rand in fixed deposits. So that's the only times that a fixed deposit will be better, is for the conservative investor, and that's basically their only money, so there's not going to be a tax problem. Even if they earn 120,000 rand in interest, they're still not going to pay tax because it's the only income that they earn. The endowment is always going to beat the fixed deposit. There's just no question about it. Especially if you are going to compare 5-year to 5-year fixed deposit. After taxes and growth, fixed deposit always going to lose against the endowment. Userum says, tax-free investments, ETAs for 20 years, safe and long-term. That is, if you feel like it, then you do that. I like tax-free investments. I think I've already made that clear. I don't like tax-free investments that's not done for a long period of time. If it's done for too short a period of time, you're wasting your time and your money. Absolutely. But if you're going to do a tax-free investment for a long period, like 20 years, and you do an ETF that's in line with your risk profile, then it is absolutely safe over the long term, and that's a good investment for you. Remember, not all of us, not everybody has the same need when it comes to guarantees, risk, returns. Okay, some people are quite happy to just get an 8% return on the investment, know their money is safe, they've got enough, they don't have to chase 12, 14, 16% return on investment. But then there's other people that want to see those big returns. Just depends on you as an individual what your need is. Paul says, hello meneer. Hello Paul. Henk, I'm glad. Thank you very much, Kunai. I hope, Henk, that the answer has helped you out and that you will seek good financial advice when you get to that point. Paul says, which company would you recommend for me to invest tax-free savings? Well, I get this question so often. People always ask, which company would you recommend? And you know what? I can't do this. I can't do this. Because Old Mutual, Sanlam, Momentum, Liberty, Discovery, Allan Gray, Coronation, Investec, Stanlib, Citrix, I can go on, Signia, 91. All of these companies have very good tax-free investments, okay? All of these companies have very good tax-free savings. The thing is that at the end of the day, it almost doesn't matter which of the companies you're going to choose. What is going to depend on how well your tax-free investment is going to do is that company that you choose. It's the portfolio or the unit trust inside of that tax-free investment and how well that thing performs that will make it good or bad. Just about every type of investment I deal with, people will come to me and they will say to me, I'm not happy. This broker invested me in this retirement annuity and I'm only getting 6% return on investment and it's pathetic. And it's with this company, and I hate this company, and I hate the broker because I'm just not getting any growth. And then we go and have a look at the investment, and the money is invested in a money market account. And then I have to explain to the client, but that is why you're getting 6% return on your investment. Because it is in a very, very, very safe portfolio that has no intention of growing at 14% or 16%. It just wants to keep up with inflation. That is the idea of a money market fund. Nothing more, nothing less. And then we have this problem that the client is upset with the company and the broker because the portfolio choice that was made was wrong. Yes, I agree. That broker should be wrapped over the knuckles because they didn't give proper advice. But it's not the company's fault that the investment is not performing at what the client is expecting, it is the broker that gave the advice. It's his mistake or his fault that the client is not invested in the right place. Or, and you're not going to like this, it could also be the client's fault that they invested in the wrong place. Because I've come across clients sitting in my office that says, I don't want to take any chances, I want to be very safely invested. And I say, well, then I'm going to have to put you into something like a money market or a stable fund, and it's only going to give you 7 or 8% return. Yes, that's fine. I'm happy with it. I don't want anything more. 3-4 years down the line, they walk back into my office and they're very upset about the fact that they're not getting good growth. And I'm like, well, let's go back to nose. Remember when you told me you want to be safely invested? Then suddenly the story has changed because now we want better growth. So you know what? I know I'm telling you a lot now, Paul, with regards to the companies and which is the best to invest in. But I really feel that you can't stipulate which company because it's all going to depend on what happens in that portfolio. If you were to take out 2 tax-free investments, okay, like we said, no, it's not a good idea. But if you were to take out 2 tax-free investments, and you do a tax-free investment with Allan Gray in their money market account, and you do the other one with Old Mutual in the Global Equity Fund, after 10 years, that Old Mutual investment would have outperformed the Allan Gray investment by 150 to 200%. Purely because the portfolio you chose with Old Mutual was a more aggressive fund that's been doing spectacularly over the last 10 years, while the one that you took with Allan Gray is a money market account that's not expected to do very well. So Paul, do yourself a favor, speak to somebody, get some financial advice from somebody that can actually show you the different portfolios of different companies and make a good recommendation which is in line with your personal risk profile, the amount of risk you're willing and can take as an investor. And then you go and make your decision. Okay, Paul, it was a bit of a long explanation, but I'm actually glad you asked the question because I get it very often and I think there's enough people on the call that it will be of benefit to them all. Graham G says, if you're withdrawing from the tax-free savings, are you effectively reducing the maximum life capping? No, you're not. So the 46,000 Rand per year limit and the 500,000 Rand limit over the lifetime, that always remains, that never changes. The problem with withdrawing from your tax-free investment is, let's say, for example, you have been investing for 3 years, you put away the maximum of 36,000 Rand per year. It means that you have put away 108,000 Rand over a 3-year period. Okay? So you still can do 392,000 Rand. Am I right? Yeah, 392,000 Rand in the rest of the period. But if you go and draw the money that you've invested now for these last 3 years, the tax-free growth that you've gotten is so small in comparison to what it would have been on a unit trust or an endowment. If you had exactly the same funds on the tax-free investment versus an endowment, the difference in return because of the tax-free investment over that 3 is going to be like this. 10 Rand difference. Okay, it's not that, but you know what I'm trying to say. So the problem is, what you are effectively doing is, because you're not leaving it in there for 20, 30, 40 years, you're losing out on all that compound tax-free growth that you're going to get year on year on year on year on year. And now you're not going to get it on the full 500,000 that you could have filled up. You're only going to get it on 392,000 because you withdrew the first 108,000. And this is what I went on, that I was going on a bit earlier as well. People do tax-free investments and they invest in it for 12 or 18 months. And then they draw the money and they go and they have a big holiday. And I feel very chuffed because I've withdrawn money from my tax-free investment. I got tax-free growth. I gave SARS one. No, you gave yourself one. Because that tax-free plan has not even done close to what it could have and should have done for you. You should have used other monies to go on your holiday. You've just shot yourself in the foot. Okay, let me get off my soapbox. EQT, Old Mutual, correct. That's the one I was talking about, Khomoto. Sikopa, hi mister, I just want to know if one can continue receiving their 13th check on their retiring. Well, I'm not a labor specialist, but I would say no. So when you retire, you do not get an income from your company anymore. And therefore, if the rules in your company were that you got a 13th check once a year, that rule falls away because you now got a pension fund, which is not an employer-employee relationship, and therefore you only get what that life or living annuity is going to give you for the rest of your life. So no, you won't get a 13th check. I do think that there are some pension funds, like I know there's a mining pension fund, I think it's called Sentinel, that people can still get a bonus check. But it's few and far between, and it's specific to specific industries. So I think if there's 3% of pension funds that still does that in South Africa, it's a lot. So just take it as given. No, you won't get a 13th check, okay? Ants, man, should I draw my two-pot and put the money in the tax? Ladies and gents, can I introduce you to Ants Man, Mr. Anthony Beer, who is one of my colleagues, and he is literally taking the piss out of me now. Oh, sorry for that word, but he's taking the mockers out of me because we get this question so often. Should I withdraw my two-pot and put the money in the tax tree? No, Ants Man, don't do that. Don't do that. Don't take money out of your pension, pay tax on it, and then put it in tax-free investment. Doesn't help, okay? It's not a good idea. Charmaine Meeker says, do we move money around now with this war? Things are not looking good. Charmaine, you should have been here earlier, because I've said it and I'm saying it again. Don't move your money. Just leave it where it is. Don't let the war worry you. It's a blip on the radar. And the money will recover, the investment will recover. If you have an investment that's taken a bit of a knock over the last month or two, or even the last week or two, just relax. It will recover. It's not World War III. That would be a different situation. We hit something like that, things might change considerably. But this little war, and I said it earlier, just think about the war between Ukraine and Russia. How long has that been going on? 2 years, 3 years, I don't even know. How much was the impact on markets on that? For the first 2-3 months of the war, definitely after that people were like, oh, whatever, it's Ukraine and Russia. This, I personally think, is going to be the same thing. I mean, let's be serious. Iran doesn't really have any chance against the combined forces of Israel and the USA. So they've basically shot themselves in the foot by not wanting to play ball. So just leave it, Charmaine. Please do not move your money. Don't withdraw your money. I promise you, if you do it, you will be wanting to reinvest it when it's too late. You'll be trying to time the market, and you are going to be hurt very, very big time. Don't do it. Tic-tac-toe, good evening, mate. Nice to see you again. Pillay, is gold a good go during the war? Pillay, I don't know. I've said it so many times, I am not a commodity trader, I'm not a share trader. I don't like to go into specific industry. What I can tell you is gold has always been the place that people run to when there is something that scares the world. So war scares the world, and then people normally run to gold. It's a safe haven. Now, I honestly don't know. I mean, gold has had an exceptional run over the last 2 to 3 years. So gold is basically on all-time highs. It's taken a little bit of a knock lately, or not a knock, just basically bans out, but it's already started selling again. So I don't know. Personally, I won't put money into gold. If I was a gambling man and I had money that I'm willing to lose, yeah, then maybe I will. But definitely not now, because there's a bit of war. That's my opinion. Sorry, Paul says, pleasure, Paul. Tic-tac-toe, so who is going to pay the 30? Brahm says, at what point do you pay tax on interest received from your fixed deposit? So Brahm, you do that basically at the end of the year when you do your tax return. So remember, your tax year runs from the 1st of March every year until the 28th of February next year. So basically, we just closed off our personal tax year. So all the income that you've received for this year, from 1st of March until 28th of May, will be on your tax returns that you're going to do in September. So all the interest that you've earned will also be added to this income from the 1st of March 2025 until the 28th of February 2026. All income, all interest earned in that year gets added together, all gets sent to SARS. You do your tax returns, I think it's normally August, September, and therefore if any tax is payable, it's payable this year, later in the year. And that, Brahm, I'm telling you, because that is just about all I know about taxes on interest outside of investment talk on taxes, okay? Who's next year? Let's see. William Rhodes. We are almost ready to go. What? Oh, William says, gold fell this week because of people taking profit and moving it into other assets. William, it's very possible. It's absolutely 100% possible. A few weeks ago, last weekend in January, specifically, you can go back and you can go and check it. Last weekend in January specifically, we were a bunch of old schoolmates that came together, had a bit of a kaya and a braai, and as per usual, because I'm a financial advisor, we eventually started talking about investments, whatever, and I was asked the same questions about gold and silver and would I be investing in it, and I gave them basically the same answer that I gave you guys. This was the Friday night. Saturday morning when we woke up, that is when gold lost, I don't know, I think something like 15% overnight, and silver went down by 25%, and I showed everybody, and everybody was in shock. And that was exactly the same thing. It was people taking profit because a week or two later everything started recovering again and went up to the same high prices that it was. And I think this is one of the things that if you are not a educated investor, you will not pick up things like this in the market. People won't see it when there is profit taking and will just think that, oh shucks, something is wrong, look at it, it's making a nosedive. And that's when people start panic selling, and when they panic sell, they lose money. So, William, thank you very much for that. I do not know how correct you are, but I will absolutely accept what you're saying. Brahm says, or Tic-Tac-Toe says, any interest earned about 23,800? Yes, Mr. Tic-Tac-Toe. I do think that Brahm realizes that, but if he didn't, then now he knows. Thank you very much for pointing that out to him. So, ladies and gents, thank you very much. I really enjoyed it as per usual. It was fun chatting to you all. I need to go and send Mr. Anthony Beer a message now for him making his joking remark here. For the rest of you guys, thank you very much again for another evening spent with me. Next week, Thursday, we will do it again. I look forward to chatting to you all. Have a great evening. If you haven't had supper like me, go and have some nice supper and have a great evening, great weekend. All the best. Keep well, folks. Bye-bye.